Good evening, everyone, and it's a pleasure to have a chance to visit with you a little bit about the cattle market situation. There's whoops, hang on, I turned my own slides off. How do I get them back? Hang on, I can't see my own slides at the moment. What did I do?
I'm used to having the two screens too. It's tricky when you flip back to one and try to do the zoom.
That's not what I want to see. Hold on, sorry about this.
You want to stop share and just reshare?
Yeah, that's what I'm going to do. It's still not. I don't know what I did. Oh, there we go. Okay, you're seeing my PowerPoint in slideshow mode?
Yes.
Okay, I won't mess with it anymore. So yeah, it's good to have a chance to visit with you. I am actually traveling. I'm in a hotel in Lincoln, Nebraska tonight, and I'll show you tomorrow morning. I'm going to give a very similar presentation. Only the title slide is going to look like this, because I'm speaking at the Red Angus National Convention. So it's going to be the same material, though. In fact, I probably won't have to do any additional changes to the program for tomorrow. So let me jump right in and go through some of this. I'll try to go relatively quickly through some of this to set up the discussion about what you can do. Obviously, you're in a very tough and unique situation right now. But this will be a bit more of the big picture backdrop to where we are. So I'm going to start here with a really long-term view, but where we find ourselves as of January 1 of this year, the all cattle and calves inventory in the U.S. was the smallest since 1951. So that's what that red dotted line is showing you. You got to trace back to 1951 to find this level. We're smaller now than we were about 10 years ago when we had the last drought reinforced cyclical low in cattle inventories. We're even smaller than that now. So, we're in a multi-decade situation. I've got several measures. I'm going to refer to this several times, and you'll see it by any measure you want to use. We're in a very unique situation. The beef cow herd, which drives most of the dynamics of the industry, of course, and is the main source of supply in the industry, is actually at the lowest level since 1961. So, again, we're in a very unusual situation. It's a little more clear here that we're even smaller now than we were in 2014, which was also precipitated by drought conditions. There are some similarities to the situation now and then, and I'll talk about those, but there's also some very important differences now that I think are really important to keep in mind in terms of what we expect going forward. So that'll be where we're going to end up talking about where we go from here. One final slide here in terms of the situation. This is a chart of the U.S. calf crop. So this would include both beef and dairies, all calves. We don't actually get a breakout of them between them. And of course, now there's not as much difference as there once was. But on the right-hand side, I've made estimates of what I think USDA may tell us about this year's calf crop. We won't get that number till early in 2025. But I think they're going to tell us that it was just a tick over 33 million head. And I went back and did some estimating. I had to do some estimating on those early years, but I think this is probably the smallest U.S. calf crop since about 1941. So again, by any measure, we're at multi-decade lows. We're very tight on cattle numbers. We've been getting smaller now since 2019 with the herd, actually since 2018 with this calf crop. We've been getting smaller. And so obviously that has lots of implications for what happens going forward. This chart, the black line is that same inventory, cattle inventory line, but the red line then shows what happens to beef production. So, beef production increased as cattle numbers increased from 2014 to 2019, from 2015 to 2019 was the increase, and it would have peaked out probably in 2019 or 2020, but then we got into more liquidation. And of course, when we liquidate in the short run, we're eating those animals as we get smaller. So beef production actually continued to increase till 2022. It was an all-time record. We are starting to come down in beef production now. In 2023, we dropped about 4.7% year over year. And we started this year saying that we would be down about that same amount this year. I'm going to talk about it. We're not going to be down as much because of some of the things that have happened this year, but we will still be down on beef production, and we expect beef production to be down for in 2025 and probably on into 2026 as well. So kind of a look at calf prices. Now, these are Southern Plains basis, so you know, you kind of have to adjust them in your mind for where you are in the country relative to that. But the general pattern should be the same, obviously. And I'll put these in perspective in just a minute. But you know, we worked our way higher through 2023. That's the dotted line. We peaked out actually this year so far in March, and then we've drifted a little lower through the summer. And of course, markets took a pretty big hit in early August, really through the futures markets, but that was caused by macroeconomic shocks over in the equity markets. And so, you know, so we've been kind of, we've been a little bit lower, but that's more of a short run phenomenon than it is, you know, certainly doesn't reflect any change in fundamentals. We don't have more animals now to fundamentally push these prices lower. It's just all of these other dynamics in the market. Big feeder cattle's kind of the same story. You know, again, we've been at record highs at various times during the year. We're off of that a little bit. Some of that's coming out of summertime. We've been in kind of the summer doldrums, but as we get into the fall here, I think we'll see some different dynamics develop here in these markets. Fed cattle, same story basically. We've been, you know, we're still above year-ago levels, although we're right close to year-ago levels right now. You know, again, we've been at record levels for all of these cattle markets at some point in the year. We're not very far away from those. If you put all three of these on a chart that shows it over time, it's much more, there's a much better perspective, I think, of what's going on. And so you can see on the far right-hand side where we are now, and these, you know, these recent decreases we've seen, this really puts them in the context of, yeah, we're not quite at the record, but we're very close to it. And this also puts the current markets in the context of what happened about a decade ago, the last time we went through something like this. And you know, what I think people, when they look at this and they say, yeah, okay, what we've got right now is equal to the left side of this thing. Let me see if I can kind of point to this. It looks like the left side of this, you know, so we're, you know, maybe we're near the peak. Well, spoiler alert, I'm going to come back at the end and tell you we're not at the peak yet, because these peak prices that happened in 2014 and 15 were about a year to a year and a half after we started trying to rebuild the herd from the last low. We are not rebuilding the herd yet. So we'll go through that in more detail in a minute. But the point is, we're not at the conditions in a cattle cycle that would put the peak in prices at this point in time. Just to round out the you know, classifications of cattle, cull cow prices have been moving higher every year. Each one of these lines kind of shows the last 4 years. And so we've continued to move higher as we go forward, and we'll see that the cow numbers are actually, and the cow side of the meat market is really the tightest part of the entire market right now. And even bred cow prices, now these are auction-based prices. I don't get good numbers. I hear things out in the country. Obviously, country sales are where most of the higher quality bred cows are going to be traded, and at much higher prices. But this certainly picks up the idea that we're going to see, we are seeing, and will continue to see, you know, bred cows or bred heifer prices continue to move higher. I expect that we really haven't hit the, you know, sort of the big push in demand for these animals, because again, we don't have any real indication that we're very actively as an industry trying to rebuild the herd for a variety of reasons. And so we'll talk about that. This is going to get closer to home for you then. If you look at this drought map, this is this morning's drought map. You know, and you can make two comments about this. You know, one is that really, if you look at the darkest color, so the reds and the dark browns, there isn't very much of it around the country. You guys in West Virginia, unfortunately, are in one of the spots that's as bad as anywhere in the country right now. As a nation, there's not as much drought, severe drought, But when you look at that map, there's a lot of marginal drought conditions that have developed over the last few weeks. And that's a real concern, broadly speaking, in the industry. So you're dealing with, managing through a drought, and that's a very unique situation. We've been through that a lot in the Southern Plains, and so and we don't, we have not had that. But if you look at the map from back in June, you can see how much more drought conditions have developed to various degrees around the country. And so that's one of the things that's a big concern going forward, obviously, is where we are with that, and how that might impact what we can do or have to do relative to maybe what we would like to do. Having said that, the last couple of years, broadly speaking, we've had better forage conditions. 2023 and 2024, on a very broad brush level, have had better pasture and hay conditions. Hay supplies have recovered from the very low levels in 2022. But again, and I know, at least in Oklahoma, we actually have very large hay supplies now. We carried over a lot of hay from last year. We produced a lot of hay this year. Quality could be perhaps an issue, but nevertheless, there's a lot of tonnage out there. So from that standpoint, a lot of places are in a little bit better shape. Now, again, if you're in the middle of one of those areas of the most severe drought, then these become very important questions. Now, maybe that's one of the things that's an alternative. I don't know exactly what your local or regional conditions look like there in terms of the potential to source feed resources. I'm sure you've already been dealing with that. But those are the kinds of things, at least from a broad standpoint, there is more hay around the country. Now, I don't know, again, how far away it is from where you are and the feasibility of being able to utilize those resources. Hay prices have come down from the peak levels. Now, these are average national prices. Regional markets are much more important generally for hay. But we're seeing that these prices have come down sharply in some regions because of the recovery in hay production and hay supplies, broadly speaking. Corn prices, again, we had a record corn crop last year. USDA just put out their latest forecast today, and they're calling this year's corn crop not quite as big as last year's record level, but not much under it. It's still a very big crop. So we've really pulled these corn prices down, and that's going to capture supplemental feeds, broadly speaking. Again, that's one thing that may be useful or helpful to producers having to try to manage through drought, is that at least in some cases there is potential for some supplemental feeds to be a little more economically available than they have been at times in the past. So corn prices. Now, from an industry standpoint, the biggest impact, of course, of corn prices is on the feedlot side. What that does for them as a sector, and also how that translates back into feeder cattle market demand, or feeder cattle demand from that sector. Here's a couple slides on the corn crop. I already said that we've got close to a record crop again this year. The number they put out today was just slightly higher than that right-hand bar here, just a little bit higher than that. And what the big corn crops do is give you higher ending stocks. That's when the prices come down. The market's not worried about running out of corn when we're carrying over, 2+ billion bushels at the end of the year, the end of the crop year. And so that keeps those prices generally lower. Lower corn prices feeds back into the feedlots. This is Kansas-based feedlot data. Corn, feed cost of gain in the feedlots went up dramatically from 2021 through the year 2022, peaked out in the first half of 2023. That's the green line up there at the top, and then started working its way lower as we got into the larger corn supplies last year in the latter part of the year. And then so far this year in the blue line, we see these feedlot cost of gain comes down. So that's helping the feedlot sector a little bit, providing some relief there. It also allows them to basically chase feeder cattle a little more heavily. Once feed costs are down, they can try to bid a little more aggressively for feeder cattle. That's going to be their biggest challenge going forward. Feedlots are not going to have it easy, even though they are getting some relief on the feed side. But because of the tight supplies of feeder cattle, they're still in a situation where it's going to be very difficult to maintain volumes and margins, even with this help from lower feed costs. Cattle on feed numbers, the dotted line, the black dotted line here is this year. For the last 3 months, we've been right on top of last year's numbers, basically, very, very close to it. We have not seen feedlot inventories decline like I think they have to at some point. And I'm going to say it that way because it always takes longer for the adjustments to take place than I think. Feedlots obviously don't want to lose volume. They're a volume-based business. They're really in the feed business, and so they're trying to keep volumes, and they've been very successful, largely speaking. Now, feedlot numbers actually did peak in 2022. That's the blue line. But for the last year, feedlots have done a good job of not seeing continued decreases in those feedlot inventories for a couple of different reasons. Now, this chart shows you the blue line is the actual monthly numbers, and it's very seasonal. That's why it goes up and down. It's kind of hard to sort of see the trend. The green line here is a 12-month moving average, which takes that seasonality out, and you can really see the trend. And on the right-hand side of this chart, again, from the peak in 2022, feedlot inventories did start to fall. They've actually gone back up here for the last few months because feedlots have been able to scramble around, I'm going to say it that way, and find some additional cattle to put in the feedlots temporarily. But this chart highlights what happened a decade ago. So if you look back over there to 2014, feedlot inventories did get down, about 1.1 million to 1.2 million head lower than they are now. We're actually smaller than that now, if you remember that calf crop number from earlier. So feedlot inventories will have to come down at some point. But again, feedlots have been very good about putting that off as long as possible through a variety of means. One of the biggest ones is the fact that we have continued to feed heifers. And so the heifer on feed as a percent of the total cattle on feed remains at the upper end of the range, pretty close to 40%, with the July number, which was the last one. In the October cattle on feed report, we'll get another quarterly update of that number and see whether that's beginning to come down. But frankly, I've been expecting it to start declining some in the last year, and it simply hasn't at this point. So producers have been content to sell heifers into this stronger market, the feeder heifers, and feedlots, of course, are happy to have those animals, so they've continued to feed and place and feed those animals and going forward. Now, if you look at total feedlot placements, they have been generally trending down. They actually peaked pretty close or shortly after the calf crop peak, and we have in total placed less cattle in the feedlot. Now, it would have dropped more sharply had we not continued to place and feed those heifers that we just looked at. But the other reason that feedlot inventories have not come down very much is because we've continued to push days on feed. Feedlots don't really care what they're feeding. They just want something out there to feed something to. And so we've really pushed. Now, it's been trending up for a long time. Some of that's structural, related to, genetics of the cattle and feeding technologies. But in the last few months in particular, we've really pushed those feedlot inventories or the days on feed, higher. And, again, you can take fewer cattle and make them look like more in the feedlot if you slow down the rate at which they exit the feedlot. And that's basically what we've been doing. Now, the consequence of that is, well, we'll see it in just a second here. So if we look at cattle slaughter numbers, the far right-hand column here, steer slaughter so far this year is actually only down about 0.5%. And that's surprising. We started off with the idea that we would see another year, kind of like last year, with steer slaughter down. Heifer slaughter, I've been expecting to come down, but, again, not so. Based on the numbers on feed, we have not seen heifer slaughter decline that much. Now it is coming down through the year, relatively speaking, but it's still down 2.1% so far this year. So total fed cattle slaughter is down just a tick over 1% at this point. That's less than we expected, with implications on the meat side. The thing that is down sharply this year is cow slaughter. So dairy cow slaughter is down 14%, beef cow slaughter over 16%. They're about half and half of the market. So total cow slaughter is down about 15%. And so that non-fed side of the industry is very tight, as we will see here in just a second or two. Now, yes.
I want to interrupt you, but just
no, that's fine.
Back to your heifer deal. What kind of decrease in heifer placements to the feedlot do you think are indicative of herd building that's going to start this recovery, or what should we be looking for on the building a cow herd side of those numbers?
Great question. We're looking at the meat side of it. The flip side, of course, is the herd rebuilding question. But this chart, and I went back to this chart because it really illustrates. So if you look back over here at 2015 and 2016 and 2017, that's when we were most actively building in that last cyclical expansion. And so that heifer on feed percentage dropped down in the low to mid 30% range, as opposed to being up around 40%. So and that red line that's on there is actually the long-term kind of average. So until we see that heifer on feed percentage, certainly it's got to drop below the average to even start getting into the range that would suggest any heifer retention. And so that's a great question, because that's exactly, that's really the key going forward here is seeing that. We'll look at this again a little bit when we get to the end and talk about it from the cattle cycle side of things. So yeah, great question. So bottom line is cattle slaughter's down just a tick over 4% so far this year. I really thought it would be down, probably closer to 5.5 or 6% this year. But again, we've not done that. One of the implications of feeding those cattle, and it's both steers and heifers, I only have the steer chart here, but is that carcass weights have been running way heavier this year than last year. I haven't recalculated the year-to-date average for the last couple of weeks, but yeah, it's running up around 23, 24 pounds. I think in the most recent week, these steer carcasses are 28 pounds heavier than the same week a year ago. Now, they go up seasonally in the fall of the year, so the idea that they're going up right now is not a surprise. You can see it in every one of these lines, but we're just so much higher than a year ago. And so what we're doing is offsetting, and also the fact that the slaughter is not down as much. The combination of those, beef production, now this is a weekly chart, but if you look at it, there's a number of weeks in here where we're actually bigger than last year. Total beef production for the year is only down about 1% right now, year to date. We started the year saying it would be down 4.5%. Then we cut it to 3.5%, and then 3%. And now it looks like we might end the year with beef production down somewhere in the neighborhood of 1%, perhaps 1.5% as we go forward. USDA's number today, I think they've got beef production only down about 1%, or maybe just a tick less than 1% for this year on a year-over-year basis. So, but if you look at how we're doing that, it's the fed beef side. It's those steers and heifers where slaughter's bigger than expected, even though it's down. Carcass weights are much bigger than a year ago. And so you can see on a weekly basis, the fed beef production has been running, pretty consistently above a year ago for the last 3 or 4 months at least. And so fed beef production is actually up over 1% on a year-over-year basis. And the fact that total beef production is still down somewhat is all coming from the fact that the cow slaughter and bull slaughter is down. The non-fed beef side of the thing is much tighter. So we've got this kind of discrepancy between the fed beef and the non-fed beef side of things, and that has lots of implications for ground beef markets and demand for lean versus some other things. And so we're seeing some of that in the cuts that I won't get into, but I've got all that stuff that I sort of look at. So Beef production, again, I changed this just a little while ago to put it down 2% for the year. I suspect it probably will actually be less than that. We had it down 4.5% to 5% at one point earlier in the year, and it just keeps we keep raising that estimate of 2024 beef production. And so there's lots of pork and poultry. In most of my presentations in the last few months, I haven't talked much about competing meats because honestly, we just don't see a lot of impact. There's lots of pork and poultry out there. If people wanted to turn away from beef, they could. There's very economical alternative proteins in the market, but we continue to see beef demand pretty strong. We'll look at that here. Beef wholesale levels, box beef prices have been at or above year-ago levels most of the year. We're pretty close to last year's levels right now. And so we've held up pretty well. And really that's in the face of a slight increase in beef production or fed beef production that we just saw. Choice select spread, I just put this in here. If you're involved in a program, those things become very important. It's following a normal seasonal pattern. It's been less than a year ago, and even less than the 5-year average part of the time. And really that's coming from the issue that I just talked about. There's actually been a relatively stronger demand for the select side because there is more demand for lean in the market right now because of the significant drop in cow slaughter this year. That's one of the things, but it's still behaving pretty much normally, just at slightly lower levels. Retail beef prices, as I said, have held up well. July's all fresh, and that's the latest data we have. July's all fresh price was continuing to move up and at a record level. If you look at it over time and smooth it out across the year, we continue to see, now these are nominal prices, so I'm not making any adjustments for inflation or anything here, but we continue to see these prices move up. Okay, exports, just a couple slides here. I'll try to do this quickly and then wrap up with, sort of where do we go from here? I'm still kind of telling the story of how we got here and what the situation is. But beef exports actually peaked in 2022. Coming into this with declining production and high prices, we expected to see some beef export decreases, and we did in 2023, about 14% year-over-year decrease in total exports. And you can see the various markets. The Asian markets represent the majority of it. Japan, South Korea, China, Hong Kong, and Taiwan are 4 of the top 6 export markets. So you can sort of see that there. Through June, I didn't update this for the July data, but through June, you can see that we're down. Now we're not down. Actually, July's monthly exports, which is here, was actually higher than a year ago. So for the year to date, we're actually only down about 2.9% on beef exports. And that's, again, another encouraging sign that beef demand is actually internationally is holding up relatively well. I suspect we could very well end the year still down slightly, but it's not clear at this point that we will see, and certainly we won't see the kind of decrease in beef exports year over year this year compared to what we saw last year. So on the import side, we do import beef. Not surprisingly, when supplies get tight in the U.S. and prices go up, we import more. So we did see increases imports last year. We're seeing increased imports this year. And again, much of that is that processing lean beef that we use for our ground beef market. So it's really trying to moderate the decrease in non-fed beef production in the U.S. It doesn't offset it. And it doesn't, completely, and it certainly doesn't really change the overall market environment, but it does moderate it. It's kind of a normal market response to the conditions we see in our domestic market. Live cattle trade, this is the history of cattle trade from Mexico. So we average about 1.1 million head a year. We're going to see a little more than that this year probably, but it's really within the range of normal trade. Nothing dramatic happening. Now, Mexico has had a fairly severe drought this year. Combine that with the fact that our prices are at record levels, it's not surprising that we're seeing some increase in cattle imports from Mexico, but there's a limited supply that can come up in any event. And so it's not a really massive change of any kind. Just again, kind of a marginal response to the market conditions here as well as the conditions there. Canada, again, we get a wider range of cattle imports from Canada. The majority of them are slaughter cattle, either fed cattle that go straight to slaughter in the U.S. or cull cows and bulls that go straight to slaughter in the U.S. The green part is feeder cattle that come in. And again, so far this year, we're seeing some increase in those, but pretty much what you would expect under the current market conditions at the margin. And again, we're not talking about massive changes, just kind of marginal adjustments in these things. Okay, I'm going to wrap this up as quick as I can here in the next few slides. Here's heifer slaughter as a percent of cattle slaughter. So this kind of gets back to your question, Jerry. You can see we've continued to slaughter heifers. You can see what it did again at the low point in 2016. This was heifer slaughter as a percent of all cattle slaughter. So it got down around 25% when we were actively holding a lot of heifers. We've been up there around 31% at this point. And so we do need to see that come down over time. We aren't really seeing it at all yet. So we've got a long ways to go, I think, to see that. One of the real questions for the next couple months this year is, do we save heifer calves this fall out of the fall run of calves? I thought we'd see some last year, but we really didn't. I think there's a chance we'll see some this year, but I'm not convinced that it's going to be very aggressive at this point, and that it will have a lot of impact. This female slaughter thing is really key to what can happen to this industry in the next couple of years. So you can see from this chart that in the last 2 years, 2022 and 2023, on an annual basis, female slaughter, so cow plus heifer slaughter, has represented more than 51% of total cattle slaughter. And that has not happened, you can see from this chart, since 1986 was the last time that we did that. Even in 2014, we did not see, or going into that, we did not see or actually it was 2011, 12, and 13 was the worst drought. We did not see that kind of increase in female cattle slaughter. So now if you look at it on a monthly basis, if you look on the far right side, you'll see it is starting to tip down. That's probably headed in the right direction, but all of that decrease you see in there is from the increase in cow slaughter. The decrease in cow slaughter. The decrease in cow slaughter, it's not from decreased heifer slaughter. So it's all the cows right now, but really to get back to indications broad-based that we're trying to rebuild the herd, we got to see both cow and heifer slaughter decrease. And so this is what USDA tells us is the supply of replacement beef heifers. They made big adjustments this last year, so 2023 and then 2024 even tighter, and those are the smallest. The 2024 number was the smallest beef replacement heifer number since 1950. Again, another measure like those that I started with, all of which adds up to just how tight the situation is. And so if you look at this chart, this shows the year-over-year percent change in that beef replacement heifer inventory. And all I want to show here is that it really started in 2012. But in the period where we rebuilt the herd the last time, we had year-over-year increases, including one really big year of heifer retention. If you go back to the 1990s, another cattle cycle, we did the same thing. We have not been setting ourselves up to do that this time. Okay, we've continued to slaughter heifers, which means we're not saving replacements. We might save a few more this year, but honestly, I think our ability to do much really will still be at a very low level going forward. One of the things to keep in mind is that heifer inventory that USDA gives us really consists of two different sets of heifer calves. Part of them are heifers that are going to calve this year, so we're really measuring the 2-year-olds, the coming 2-year-olds, coming first calf heifers that are on hand as of January 1. And then the other part of it is heifer calves that we are presumably raising and developing to breed this year for the next year. And so if you look at those heifers calving coming into 2024, we didn't have very many heifers. And so the beef cow herd is still getting smaller in 2024, even though cow slaughter has dropped. That's one of the things that has to happen to stop liquidation of the herd. But you have to have heifers to replace cows, and we don't have very many heifers. So I think the 2025 January 1 beef cow herd will be even smaller than it was in 24. I don't think we're done liquidating yet. We might stabilize in 2025, but that kind of depends on, again, we didn't carry in a lot of heifers that we were presumably breeding in 24 to calve in 25. So, you know, if you kind of time it out, if you save a heifer calf in 24 this fall, if we save heifer calves the next couple of months out of the fall run, you know, we can breed them in 25, they'll calve in 26. We're going to be going into 2027 before we see any significant change in beef production. Yes. Did you have a question?
No, I was agreeing with you.
We're on a slow path here. And that's one of the things that's different from what happened a decade ago. We had the ability, because we had actually set ourselves up for a rapid herd expansion and a rapid sort of undoing of the high prices. We don't have the ability to do that this time. That's going to be my final message here in a couple slides. Beef cow slaughter, again, it's coming down if you think of herd culling, but it's still not down to the levels that would suggest that we're actively rebuilding the herd. So when you look at what we did the last time, you know, again, I use that as a reference because I think that's in our minds from 2014 to 2019. The way you do that herd expansion, of course, is that you save a lot of heifers. So this blue line gets to a peak. You don't do very much cow culling. You cut it to the minimum. And so cow culling drops to a low level. So those two things both have to happen in order to have herd expansion. And we're not really doing either one of them to the degree yet that would suggest that we're in the process of herd rebuilding. So this one is going to be a slower process because we don't have a pipeline of heifers to work with. We got to, you know, if we decide we want to do it, and I say we, obviously producers, if their expectations change where they want to start that rebuilding process, we're really starting with, again, new crop heifer calves, and it's going to be a slow process. Add to that the fact, as we saw earlier, that we've got a lot of drought still that obviously is forcing people to maybe go the other way, or at least certainly tempering any plans they might have or any thoughts they might have about herd rebuilding. And I think that's a really critical factor going forward, even in areas maybe where the drought is not as bad right now, but you look at that map, conditions are pretty marginal and producers are not getting very aggressive. That's the message I get all across the country as I talk to audiences. And then, you know, add that to the fact that we're in high interest rates and we've still got relatively high input cost. All of those things mean that, you know, we probably don't have the level of profitability yet or profit potential that really triggers a strong desire for investing in future production in terms of rebuilding the herd. So I think we're on a much different path than what happened 10 years ago. And so the bottom line is prices are close to record levels, even though we've softened a little bit in the last month or two. But really, you know, they're going to go higher. Okay. Which is a scary thing for me to say, because anytime you're at record levels, you'd expect to adjust back to a more normal level. But we have not hit those conditions yet that would put the peak in this market. We won't hit them in 24. We may not even hit them in 25, because we really have to see some significant heifer retention in order to put that final squeeze on feeder supplies that'll put the peak in prices.
Yep.
The market's really focused on cow-calf at this point, because that's where you're going to stimulate herd rebuilding. So, you know, the potential returns for cow-calf people are high. Now, I hate to say this, when you're talking about somebody dealing with drought and just trying to, you know, hold things together, this becomes in some sense kind of a secondary thing. But we do have strong markets, so if you do have to liquidate, I guess there is some potential, you know, some comfort in that. Not much, but some. But you know, in general, for the industry, the market is really focused at the cow-calf level. Now, I'll say this quickly: it probably isn't as important, perhaps, in this particular context or this particular audience. But you know, everybody above the cow-calf level is a margin operator. So if you buy calves as a stocker producer and put weight on them and sell feeder cattle, those calf prices, we saw that chart early on where the calf prices have gone up a lot more than feeder cattle prices have. And they always do in this kind of an environment. So the margins, this shows the buy-sell spread between calves and feeder cattle. All that means is that it's kind of hard to be a margin operator. And so stocker margins are going to be tricky. Feedlot margins are going to be tricky because the bottom end is coming up faster than the top end is adjusting. They're all going up, but there's time lags and they don't go up as much. And so so the margin operations are all face continuing challenges and will for the foreseeable future. Again, the market's focus right now is really on the cow-calf level, trying to stimulate that heifer retention that will lead to rebuilding the herd. So again, the peak prices will occur sometime after we start that process of rebuilding the herd. We are not there yet, and we may not get there for, you know, again, I'm not even sure it happens in 2025. I think we're looking at an extended period of elevated prices. Now, somewhere in there, there'll be an actual peak, and I don't know when that is. But I think we're going to stay at relatively high prices for 2 to 4 years. And that violates one of my cardinal rules, which is giving you a price and a date in the same sentence. But it's close to that. And I'm going to wrap up here with this slide, and this should set up then subsequent comments on risk management. And that is that, you know, I've got a very bullish market outlook in general. We're not done going higher. I don't think we've put the peak in prices. I don't think we will anytime soon. But that said, the last 6 weeks in this market has really been the latest demonstration of how much volatility you're subject to when you're at these kind of prices. And so, you know, we are bullish long term. Prices will likely trend higher over that. But you know, you've got to sell cattle at various marketing points along the way, whether you're selling calves off the cow or whether you're selling feeder cattle or fed cattle, it doesn't matter. Everybody's got marketing windows that they have to operate in, and the volatility that's out there, we've seen 2 or 3 examples in the last year where you can have lots of volatility brought on by external factors that can really rock this market for a short period of time. Now, the supply fundamentals are probably going to correct it relatively quickly, but it doesn't matter. If you're at a point where you've got to make some marketing decisions, then those short run that short run volatility becomes really critical, and that sets up the idea that even though we have a generally bullish outlook, it doesn't mean that you can slack off on risk management. It's critical, and arguably even more so because, again, we are at very high prices and we're subject to a lot of volatility, even if it's fairly short-lived most of the time. And so that sets up the idea that we really need to pay attention to the risk management. So I'll stop there. Hopefully that was not too terribly long.
That's all right. That's excellent. Anybody have any questions for Dr. Peel? Now, if you are not part of Dr. Peel's newsletter, you really, really need to sign up and get this valuable market information. And that QR code there is links, Daryl, to get you right to your registration.
Yep. If you scan that code, it'll take you to the sign up thing. This is a newsletter I've written for with some colleagues over the years. I've written it for about 22 years. So and we put out every Monday morning. We don't sell anything, you know, it's just market information, 2 or 3 short articles that both production as well as market oriented. We hope it's useful information. It's free. We're not going to try to sell you anything or give it to anybody that will try to sell anything. So, you know, if you'd be interested in getting that, you can let us know and we'll get you on the list. I'm going to stop share here so you can come back.
Thank you, Dr. Peel, for that excellent overview. We will, Chelsea, should set you up with a good conversation, and We got some time for questions in the end. I've got a couple I'd like to ask Dr. Peel if we got time, and Doc, you could be looking back to that. I mean, I'm really interested in how the dairy, that one big feed cow slaughter, was wondering if that was part of the dairy buyout deal as Chelsea's getting ready here. Is that 86 was that dairy buyout influenced the market then?
It probably did. I hadn't actually gone back and tried to analyze that thing, but that would have been about the time we did that.
Yep.
So yeah, that probably was.
So that might that makes things a little worse. So the good news is markets are strong, going to be for a while, like you said. If we got to liquidate, at least we're liquidating at a time when we've got tremendous value in our herd. And we've really pushed in these meetings, Doc, to call heavy and look for opportunities to build a better herd. And I think we can come through better cattle, right? I think that's
absolutely. Droughts are painful. They're painful. They're painful emotionally. They're painful financially in many cases. But they the thing to do is to be realistic about what you can take care of. One of the biggest mistakes that I've been through a number of droughts in Oklahoma in the time I've been here, and dealing with producers, trying to help them to make realistic decisions, because trying to keep more stuff than you can really take care of doesn't work. You can, if you try to rough cattle through and don't really take care of them to the level that you can realistically, given the situation you're in, you're just going to postpone the cost of that drought till later with reproductive problems and other kind of problems. So it's important to be realistic about where you need to get to given your situation, and to be realistic about evaluating whether there is any potential to keep feeding. There's limits to how long that makes sense, or whether you can relocate some cattle. That can work, but it's also something that requires pretty sharp, evaluation. So it's a tough situation, but it's important to just be realistic about how much rope you got left, and make sure you try to make decisions before you're plumb out of rope.
All right. Thanks for the advice, Doc. Appreciate it very much.
You bet.
Hey, and if you need drop off, go ahead. But good luck. Say hi to my Red Angus buddies for me, and I hope you guys have a good day tomorrow.
Okay, well, I will. I'm going to stay on here for a little bit.
Okay.
And I'll be here in case there are any questions if we have some time at the end.
Okay. All right, Chelsea.
All right. Well, this might be a hard presentation to follow up there, Dr. Peel. That was great. So I am Chelsea French, and I'm with Cattlemen's Insurance Agency. Just a little bit of background. So you said you're in Lincoln tonight, Dr. Peel. I just moved back home to Broadway, Virginia from Lincoln. Yeah, went to school in Oklahoma, judged livestock there, then went to Arkansas, and got my master's in poultry science, and went into the poultry field for a while, and then had a little career change and started as a crop insurance officer when I was in Nebraska. So I did that for the last almost 2 years, and then had the opportunity to join the Cattlemen's team as a crop and livestock insurance agent whenever we moved this summer. So let's see. You guys can see these slides, right?
Yes, ma'am.
Yep.
Okay. All right. So just a little bit about Cattlemen's Insurance Agency. So we were founded by cattlemen, and we're here to serve cattlemen. We specialize in cattle-related risk management products, or I like to say livestock-related risk management products. So just to name a few of those that we are offering: LRP, which is livestock risk protection; PRF, pasture, range, land, and forage; mortality policies. So if anyone, makes a big purchase on a bull, or has a donor cow, or even some short leg stuff, we can cover that for mortality. We do farm and ranch coverage, transportation coverage for any guys that are hauling livestock. And new that we'll be offering now is multi-peril crop insurance to cover things like corn and beans and stuff like that. So we'll jump right in after talking about kind of the cattle market and what we're expecting. We'll talk about livestock risk protection. So what is livestock risk protection? This is a subsidized protection for a decline in the national cattle market. So I've got that bolded there just so that everyone fully understands this is national price protection. So it's not necessarily talking about what you sell your specific calves for. It's based off of what the national cattle market prices do. So with this product, you're able to lock in coverage prices for the future. And then based on where the CME futures markets close each day, that's going to determine whether or not you're going to be paid an indemnity there. The coverage price or the insurance that you're buying is going to be compared again to the CME feeder cattle index or the cash price of cattle, and that's on your endorsement end date. And again, what you get for your cattle does not matter in this scenario with LRP. So producers are able now to cover up to 100% of the expected ending value or the price, and that price is going to be based off of an 8-weight steer. There's going to be price adjustment factors depending on if you're doing lightweight steers or heifers, or if you're doing heavyweight heifers, which is going to be those 600 to 1,000-pound heifers. There's also adjustment factors for unborn calves, Holstein influence, Brahman influenced, etc. You are able to lock in a price with LRP, and it can be anywhere from 13 to 52 weeks out into the future. So those are the endorsement links that we have. And with that, now there's not always going to be a 52-week offering. It just depends on what the offerings are each day, but it can go that far out. One requirement with LRP is that you do have to own the cattle when you buy the LRP endorsement, and then you must own them at least 60 days prior to your LRP end date. What that means then is that, let's say you've bought an LRP and that end date was September 15th, and you get into August and you're like, you know what, I think I'm going to go ahead and sell these calves. You can do that because you're still within that 60-day window. So on feeders, another big thing to note with feeder cattle, you do not have to sell the cattle. Now, if you did LRP on fat cattle, you do need to, they have to go to slaughter. But feeders, you can hang on to them. You can sell them much later than what you had initially expected. That is an option with these feeder cattle. And then regardless of if or when they sell, your LRP indemnity, again, is based off the CME index on your endorsement end date. So just to highlight some benefits of LRP, you're able to establish a price floor with this product, and then your upside potential is wide open. It's very convenient, easy to use, pretty straightforward. You don't have to deal with the margin calls or brokerage fees. And then because you go into this knowing what your premium is upfront, it does not matter what the market conditions do. That premium is not going to change. Your coverage price that you locked in is not going to change. So there's essentially no way for you to get upside down in the situation. Another huge benefit of LRP is that it's offered on a per head basis. So you're not trying to fill a contract 50,000 pounds. If you want to do 5 head, you can do that. There's not a minimum amount of head that you can cover. Premium is not going to be due until after the end of your insurance period. So if we go back to that September 15th example, if that was your end date, you don't have to worry about that bill coming out then until October 1st. And then another huge benefit of LRP is that it's highly subsidized, making it very cost competitive, making it very affordable for producers to purchase. So I've got a couple really easy LRP examples here. But basically, you just have to think you've got your coverage price that you locked in, and then it's going to be minus the CME feeder cattle index on your LRP end date, and then times any kind of price adjustment factor that you might have. So for this example, we're saying that this producer locked in a $240 coverage price, and that's per hundredweight. That's what he locked in whenever he bought the LRP endorsement. Whenever his endorsement ended, that day, the CME index was 220. So that gave him a $20 per hundredweight indemnity minus his premium on those steers weight 2 and heifers weight 1. If we want to do this example for a lightweight steer, we say a lightweight steer is 110% of the value of that heavyweight steer. So we're going to have 264 that we were able to lock in. And then 242 is what the CME index ended up being at the end of his endorsement. So he had a $22 per hundredweight indemnity minus his premium. And then again, if you want to look at it from a heavyweight heifer standpoint, 216 would have been the coverage price he was able to lock in. And then 198 is what ended up being the end date and CME index. And that gives him an $18 per hundredweight indemnity minus the premium. One thing that I do want to highlight too, we do have the Virginia Cattle app that was created. And if you download this app, you are able to go down here to the bottom where it says quotes, and you're able to see the daily offerings very easily here. So if there's anyone that's interested in LRP or just wants to kind of watch what's going on, we've got all of the markets are on there. You can even watch corn prices. All of that is on there as well throughout the day. And then after 4 p.m., once the market closes for the day, then you'll see those LRP offerings that are going to pop up so that if that's something you're interested in, it's easy for you to watch. And then you can give us a call and we can lock in an endorsement. So I know that there was a lot of people that had similar situations to this picture. Unfortunately, a lot of people are still in this scenario. So this was taken, one of our agents took this actually in July on their place and feeding hay. And I know we've been feeding hay since July too. So with that being said, a big thing that I wanted to focus on for this drought meeting is pasture, rangeland, and forage. So pasture, rangeland, and forage is rainfall insurance for your pasture or hay ground, and it's all based on historical averages for 2-month intervals. So you're able to insure the value of your pasture or hay ground based on the county average value. So they're going to put a county average value on a hay acre and a county average value on a pasture acre, and you're able to insure that. Obviously, we know lack of precipitation is going to cause a lot of financial stress on the farm, and this product is here to try to help ease that burden. So how does PRF work? We are going to find your land and figure out which grid it falls in. They are roughly 17 by 17 mile grids. So you can look at this as an area-based plan. We're going to then determine how many acres are haying acres or grazing acres. And just to clarify, any livestock can be grazing that those acres. This is not limited to cattle. We're then going to determine the productivity factor, which you can go 60 to 150%. Basically, what this means, if you do 150%, that's going to give you $1.50 back for every dollar of loss that you have. You'll then determine your coverage level. You can go up to 90% there, cover 90% of the normal rainfall for the grid, and then determine which intervals to insure, and you have to do a minimum of 2. So then the rainfall and snow is going to be measured by NOAA weather stations, and then it's going to be reported back to RMA. The total rainfall is calculated based on the closest 4 to 10 weather stations, with the closest having more influence on your grid. If the final index for your interval is below the level you had insured, then you will get paid the difference in value minus your premium. So a very basic example of how PRF works. Let's say that in January and February, your grid was expected to have 10 inches of rainfall. You elected to have 90% coverage. It actually only rained 6 inches. So that means that 3 out of the 9 inches that you had insured did not come. With that being said, you would then be owed an indemnity of 1/3 of the value that you had insured for this interval. So here I just kind of wanted to give some quick snapshots of what it might look like if we were to sit down and start to work through a quote, work through picking intervals for your grid. So there's a lot of numbers here, a lot of things to look at. I'll just tell you that the purple means that indemnity was paid. So if you see more purple, that means that your grid probably has more opportunities there to capture some indemnities. On the right side, we have this loss ratio column. Those neon green boxes, that means that those are years that the producer was paid. So the more years that you see here, this is the last 12 years. And this is for a grid that's in the Moorfield area, and it's for 100 haying acres. So I believe it's 7 out of the last 12 years. If this producer would have chosen this exact plan, they would have been paid 7 out of the last 12 years. They would also have had a running total of $18,466. And that is minus the premium there. So with these products, what I always like to say, we are obviously in a very bad environment right now, specifically because of the drought, but just given the current farming environment, nationwide, input costs, et cetera, we want to emphasize leveraging opportunity and maximizing profits. So I will always start any producer out at a 90% coverage level and 156 productivity factor, just so that you can see what that looks like and we can try to maximize any profits back to you. And then here I've got another quick example just to show you on the flip side, if you were to do grazing acres, still quite a bit of purple here. You just don't have as large of a running total just due to the fact that these are grazing acres. Your hay acres are worth more. So you're you're ensuring a higher value, which means that on those, like I said, grazing acres, it's just not worth as much in this program. So you don't have quite the running total there, but you're still for the better here, not losing money by any means if this producer would have chosen to do this coverage plan for the last 12 years. So the other thing that I'll point out here, if we are sitting down and we're going through this for your grid, this loss ratio line, it's just showing you how much that could have paid out, and then it's going to show you how many years it's paid out historically over those last 12 years. And we've got more data than that in there. Right now, we're just looking at the last 12 years. So that kind of helps you choose which intervals that you would like to actually cover, because you can cover all year if you'd like, or if you want to look at these and you see, the loss ratio is pretty high here. This March-April interval paid out the last 5 out of the last 12 years. I probably want to do this interval because historically it's been paying out. And then you can look at some of these May and June, historically it's not paying out very much. So I probably am not as concerned about covering those 2 months in this particular grid. And then I did also want to show a quick example here. This is a producer that we have right now, and he has already received a little over $2,000 above his premium in indemnities. Words are hard. In indemnities this year, and he still has more intervals to cover. So that's obviously, we're in a specific situation this year with the drought. Last year and this year, anyone that chose to do PRF, they are certainly seeing the payout. But even in years that it's not severe drought, there's still always the chance that you're going to have certain months that you don't get as much precipitation as what was expected. So it's definitely something that you, over time, can look at and really see a lot of value from. So I did want to throw this up here too, just so that you guys understand the subsidies, or you could look at it as a premium discount. Depending on which coverage level that you choose, these are the different subsidies that go along with that. And since PRF is so highly subsidized, it's definitely designed to be both affordable to the producer, but also to have that positive net cash flow over time, just as we saw on those running total amounts. Over time, that's positive money there that it was sitting there for that producer. So it's going to financially help your operation. So PRF is something that you can purchase between now and December 1st for the 2025 crop year. Premium is not due until September 30th of next year. So with that being said, there's a lot of instances where, since it's not due until the end of September, you might make your premium back by then in indemnities that you're receiving. And then just an added bonus on PRF, this is not something that you have to call us and file a claim or let us know of a loss. We do not have to send anyone out to do any kind of quality samples or anything of that nature. This is strictly an area-based plan that is going to be based off of lack of precipitation. So it makes it a lot more straightforward, a lot less of a hassle for producers if they sign up for this. So some common PRF questions that get asked, does the amount of rain on my farm count? So no, again, it's an area-based plan. It's based on what the grid and the weather stations are telling us. Do I have to own the land? No, you do not have to own the land. You just have to have the insurable interest. So you have to have the livestock that's grazing it or have the rights to make the hay on the property. Does it pay if it floods or rains too much? Again, no, this is just for a lack of precipitation. What is considered hay ground? So if you can make hay on those acres and it's a possibility for you to do pasture hay, then you can say that that is hay ground. That's something that when we sit down and we go through your acres and talk about the opportunities there, then we decide whether or not you would like to go, which direction you'd like to go there. And then what documents do I need? So the nice thing again about PRF, with it being a little bit simpler of a process, there's not a lot of documents that we need from you. If you have your 578s or your farm maps from FSA office, that's great. That makes the process just a little easier, but that's not required. The only thing that is required is that if you are renting or leasing ground and you do get into an audit situation, you would need to be able to prove and provide a lease agreement and just stating that you were able to run cattle on that ground or that you were able to make hay there. So we'll switch gears here and I'll try to wrap this up as quickly as I can just for sake of time. But I did want to touch on crop insurance, so multi-peril crop insurance, and specifically revenue protection. So revenue protection is comprehensive crop protection through a dollar guarantee. So this is going to cover any kind of weather-related causes of loss, certain other unavoidable perils, and price fluctuations. So when you think about revenue protection, you think about yield and you think about price. So you're going to have an approved yield if you're doing crop insurance, and that's going to either be based off of your history, or if you're new to farming or new to crop insurance and you do not have any prior history, it's going to go off of a county value for your first 3 years. But we'll have an approved yield that's set for you as a producer. You'll select your coverage level, which can be anywhere from 50 to 85%. And then it's going to be that approved yield times the selected coverage level times the greater of either the projected or the harvest price. And that is all going to give you your revenue guarantee. So when you think about your revenue guarantee, you're going to get that number, and that's going to be a number per acre that you're guaranteed. And that is where you really need to think about, what's my cost of production? What are my input costs? So that you, oh, somebody have a question? Maybe not. So anyways, if you've got a cost of production in mind, and then you look at that revenue guarantee number, that's going to give you a sense of, okay, am I covered? Am I hitting kind of a break even area? Kind of where am I at here for what my coverage is? Now, these revenue protection plans are available for corn, soybeans, grain, sorghum, wheat, etc. Spring crops do have a March 15th deadline, so we've got some time there if it's something that you're interested in. Now, if you are going to do something like wheat, that's a December 1st deadline. So here I've got a quick revenue protection example, and this is just to kind of give a picture maybe for this year with a price and a yield loss. So in the spring, the corn price that we were able to lock in was a 466. Let's just say that this producer has a 155 bushel per acre approved yield and that he selected 75% coverage. That would give him a trigger yield then of 116.3 bushels. And then that gives him a revenue guarantee per acre of $541.96. let's just say that our harvest corn price comes in at a 380. So if we have a harvest price of 380 and we had yield loss because we're in a drought, and let's just say you get 100 bushels per acre on corn, that gives you a $380 actual revenue per acre. So if you do that 541.96 minus $380, that gives you $161.96 of indemnity per acre minus your premiums. If you have no idea what premiums might look like, I ran a quote just the other day just to try to see an average. If you had a regular revenue protection plan with optional units, you were probably looking at around $40 an acre. So that's still going to give you about $120 then on top of that. So just some closing thoughts. Again, we're in a really rough year. We had a pretty tough year last year too. We don't ever want this to happen. We don't want you to constantly get paid on insurance. You know, it's there to protect you, and we hope that you don't always have to use it. But we really do believe that producers who are embracing all of these modern risk management tools, like what we've discussed, they're positioning themselves for a more secure financial future. You're just putting yourself in a much better position if you know that you have some sort of coverage. One of our main goals is to assist producers in taking on less risk, and then in turn increasing their overall revenue. We want you guys to be successful. We want to be there to help in any way that we can. We're here to support you, and we really value the relationships that we make with those in the farming community. And with that, I will take any questions, and I've got my contact information here. I'm happy to chat with you over the phone. And like I said, I'm in the Broadway area, so very close to West Virginia, but I lived in Romney until I was 4. So still have family over there, still get over into the area quite a bit. So happy to sit down and discuss anything with anyone in person and kind of go through some of these options to see what would best fit your particular operation.
Thank you very much, Chelsea. And anyone have questions for Chelsea? And I'm sure as more people view this thing over the course of the next couple of weeks, Chelsea will get questions. We'll encourage them to contact you all for one of y'all here with the Cattlemen's Life or Insurance Agency. I guess probably as Dr. Peel alluded, we're in a record high prices and tremendous financial risk. You know, I don't know. I don't know how much longer people even be able to secure financing without engaging in some risk protection. And so I think it's very, very vital what you're doing. Thank you for your effort. Thank you for your presentation. You know,
Yeah,
Dr.
thanks for having me.
Oh, great job. And we look forward to visiting with you later. Dr. Peel, I think one thing I thought about as we've gone through this is, you know, you talked some about cow slaughter and where that is and our need to import lean beef. If you would just briefly talk about that Hamburger Nation concept that America is and the value of lean and how it adds value to our fat trimmings, and just so people have a better understanding of, you said we've got to import that lean beef, why, and maybe touch on what happens if we have to start burning up calves or earlier pulling cows to satisfy that lean need for our 50 trim, and what that could do to our market.
Yeah, you bet. First of all, Chelsea, that was a great presentation. I wanted to tell you that was really good. Yeah, you're welcome. The ground beef market is always a challenge for producers to understand, and then obviously it comes from the fact just in the U.S. we have such demand for ground beef. We are a hamburger country. That's why that article was called Hamburger Nation. Something around almost 50%, between 40 and 50% of our total beef consumption in this country is in the form of ground beef. And you can make various estimates because you have to make some assumptions to get there. But the point is, it is a lot, and there's a million combinations of things to make ground beef. Obviously, it's a ratio of lean and fat, And the bottom line is, because of the way we feed cattle in this country, we produce excess fatty trimmings, the 50% trimmings that Jerry alluded to, from our fed cattle. And those would have very limited value if we could not add additional lean to them to bring them up to ground beef specification. So it's got to be a minimum of 70% lean to even label it ground beef. But most ground beef in this country is going to sell anywhere from 80 to 90 or even a little bit higher as far as ground beef. So we need that lean. We use our cow beef to do that, or at least some of it. And some cows, young cows that get slaughtered, they pull the middles out, but they're still going to grind significant chunks of it. We use that for that, but then there's not enough of that in this country. We're efficient enough in terms of our overall productivity that we don't produce enough cull cows to satisfy that lean. So you can get it from a couple different places, but the cheapest source is to bring it in as imports to supplement. And this is the thing that Jerry was alluding to. When we take the 50% trimmings from our fed steers and heifers and bring in imported beef to take those trimmings up to ground beef values, we're actually making our steers and heifers worth more by importing the additional lean. And the other alternative would be to start grinding up lean parts of fed carcasses, and we do some of that if the price is right. In fact, we're doing some of it now. I sort of alluded to that, but in general, hamburger is kind of the market of last resort, if you will. If you've got a cut of beef, whatever it is, most of the time it has value as an intact muscle cut, and you don't want to grind it unless that's really your only alternative. So the imported market doesn't hurt the industry. It actually adds value to the U.S. beef industry, and it supports. And it's all driven by the fact that we have this tremendous demand for ground beef in this country, and so in order to service that, we have to have that lean. So it actually is not a bad thing. It's actually adding value to the industry when we do import a certain level of those lean trimmings.
Yeah, I think that's something that often, as cow-calf producers in kind of the southeast dock, we don't maybe understand the full complexity of the beef market compared to the cattle business, and it's it's something that it's good. It's a good opportunity to talk about that. And when you alluded to what you did earlier, that's kind of what made me think about. We're seeing some lean whole muscle cuts getting ground now because of this just tremendous demand, and we all seen record bull cow prices and bulls. I've talked to some people that have actually here from the bull test station that have sold, especially the first thing to go in the drought's a bull, and I've actually talked to some guys that got more for a bull that they sold at the market than they paid for him, and they bought him off the floor at our bull sale a couple 3 years ago. And so it's really a weird time.
It is, and the 90% trimmings price, which is again basically that cow beef, this year the wholesale value of that it's actually at a higher level than a number of the leaner cuts out of the round from a fed carcass. And so we are seeing more siphoning of some of those lean products into that market than usual because of that. And again, it's an overall deficit of lean beef production. And of course, we talked about those big carcass weights. So part of that a fair amount of that big carcass weights that we're seeing on the fed steers and heifers is actually fat, excess fat on the outside of that carcass. So we're generating a lot of fat trimmings. And so that also adds additional demand for lean to sort of make that stuff all balance out.
Chelsea, I think it's a great discussion that you had. If you would, you gave an example, a real life situation there. You got any idea what percentage of of our producers, maybe in your area, are taking advantage of the pasture range program? Have you seen growth in that? Is that how can we help people if we're not seeing great uptake of that? What can we
So
do to help you guys promote such a valuable program?
Yep. So we have seen growth in this, but there is a lot of opportunity out there. And I think a lot of it is just an education piece, which is why I'm always happy to jump on any meeting or go to any meeting or just be at different events just to let people know that it's out there, because I think that that's the biggest thing is people just don't know that it's even a possibility. I know, on my parents specifically, they didn't know about the product until I told them about it. And now they'll be doing that. So I think it's a lot of just education and trying to get the word out there. And like I said, I'm excited that I had the opportunity to be on here tonight. And anytime that I can be of service and, come to an event and just set up and kind of tell people about the product and make sure that they fully understand it and feel comfortable with it so that they know it's an option for them. I'm happy to do that.
Thank you very much. I guess we'll kind of wrap up here. If anybody has any other questions for Daryl, I'll field some, I'm sure Daryl will send to you. But thank you so very much for your excellent expertise and overview of the cattle market here. I guess my big take home from your talk is that, I've been trying to follow heifer slaughter. I thought for sure we would start to see some cow building, herd expansion and this is going to be a kind of elongated peak, I guess, is a take home message from your deal, huh?
Yeah, absolutely. And I'm like you. I thought we would see more kick in than has. But the positive spin to that is that the longer we don't, the longer it's going to last before we can build up to the point. We will eventually build up to the point where we cause lower prices. It's just the nature of the cattle cycle. But in this case, it's not going to be a sharp peak. And that's one of the things that I try to emphasize with people. It's not going to be a sharp peak like that 2014-15 thing. That took me by surprise at how fast we tore up our playhouse, if you will. I don't think we have the ability to do that this time. It's going to take longer. We probably will eventually, but it's going to take a lot longer this time. So we've got an opportunity here to see several years of elevated prices in general as we go forward, and hopefully that provides some opportunities for producers. Hopefully you can get some relief from your drought and give you some opportunities to take advantage of this a little bit better.
We thank you for those words, sir. And Alex, you and Brad, anything, Chelsea, we appreciate, you have some dates from us already. We really look forward to seeing you at the bull sale, and we'll visit more about that later. Alex, Brad, y'all have anything? We'll field some questions for you guys. We expect there'll be, a lot more people engaging in this webinar throughout the next couple of weeks, but we'll be in touch with you. Brad and Alex, I guess I'd leave with you all. Anything, closing thoughts from you guys?
Great presentation. We really appreciate having you guys on here. And like Jerry said, we'll have this recorded and posted on the Hardy County Extension YouTube channel. And we've been getting quite a bit of views after the fact on those. And I'm happy to share those numbers with you too if you're interested in them.
Well, from my standpoint, if there's any follow-up, if there's anything, you need as a follow-up or questions you want to forward to me or whatever, I'm happy to take care of those as well.
Great. We appreciate
Yep, same here.
Well, thanks everybody. Good luck tomorrow, Doc. Have
Thank
fun.
you.
Say hi to all our Red Angus buddies for us, and
I will do.
Appreciate greatly the opportunity, and everybody safe travels this evening if you've got to go somewhere. Otherwise, have a good evening and enjoy the rest of the week.
Thank you.
Thank you.
Thanks.
Thank you. Well, I'm getting really tired of putting together this.